Hello, hi everyone. Hopefully you can hear me. Thank you so much for being here today, either in person or online. It's great to see so many of you for what is going to be, frankly, an incredible event because we've got some really great speakers. My name's Fiona Maxwell. I am the Financial Services Editor here in the UK for Politico. And we are here to discuss the fine line between regulation, perhaps deregulation, and growth. Thank you so much to our partners, MFA, who have made this event possible. A reminder for those in the room and for those watching online that we do have a Slido where you can ask questions. Small reminder that we are only allowing you to ask questions if you put your name, so no anonymous rants allowed this time, I'm afraid. Please follow us on X as well. Use the hashtag #PoliticoRegulation or growth. And I'm going to get straight into it. So first of all, I've got a one-to-one with Jillian Flores, who is the Chief Advocacy Officer at MFA, and that will be followed by a panel discussion later. But I'd really like to welcome Jillian on stage. Thank you, Jillian. Jillian, thank you so much for being here with us today. It is an incredibly exciting time to be a financial services journalist. It is all changing, and I imagine your job is pretty fascinating at the moment as well. So, I mean, we can dive straight into it. The fine line between regulation and growth. There's a bit of a push here in the UK for maybe some changes to regulation to boost the economy. The financial services regulators have been told to prioritise competitiveness and growth, at least on a secondary objective basis. How do you think that's going?
Well, first, Fiona, Politico, thank you for putting together such a timely event with a wonderful lineup of speakers to follow. You're right, it's a very exciting time to do what you do and what I do. There is a lot going on and a lot of opportunity. When we think about the secondary objective around growth and competitiveness, so far, really positive signs to see the government and regulators embrace this and see it as an opportunity for stability as well as growth. I think looking at some of the measures already, name and shame, or the so-called name and shame proposal, forgive me for calling it that, I don't think I'm supposed to do that anymore, looks like the most harmful measures of it will be pulled back. We're grateful for that. The MiFID transaction reporting initiatives, as well as looking at AIFMD and really bringing that into the UK rule set in a way that works well for asset management across the UK.
Yeah, so you mentioned, we like to call them the name and shame rules, the enforcement rules. Those have been rolled back. So it seems like, on the FCA front, at least they're really listening to what the industry wants. Is there an area where you would hope they go even further?
I think there are a lot of areas that deserve continued attention. Some of them are really seeing through initiatives that were set up in the prior government under the Edinburgh reforms, including short sale regulation, which seems like that is on track to happen, and we're grateful. Generally looking at the role of asset management across the UK and embracing that as net positive, whether it's looking at the allocations for pension funds, for private market activity, or just generally assessing the role and growth of that type of market participant is something that we're really, again, seeing positive signs that are being warmly embraced.
And you mentioned the AIFMD review. FCA is already looking into that. I think the consultation responses are actually due by Monday. So could you give us any sort of sneak preview of what you'll be saying?
Yeah, we're really pleased to get the opportunity to continue or begin the conversation really in the UK about the AIFMD rule set, but see it as kind of a starting point, and it's narrower in scope, but looking to ensure that to the extent possible, we can all kind of take a step back, look at the different regimes, AIFMD, UCITS, and MiFID, and find ways to bring them into consistency as much as possible, really around the defining characteristics of each of them. And then beyond that, perhaps in next iterations of FCA's work, we can look at some other specific areas around reporting, the Annex 4 reporting, for example, and other measures that can continue to be improved around remuneration.
Okay. Now, thinking a bit kind of higher level, the theme of this event is the fine line between regulation and growth. Do you think there is, if the government get its wishes of kind of pulling back regulation a bit. Will that achieve growth? Do you see kind of a concern that there could be some financial stability effects or perhaps negative effects on consumers? Or how do you think it's possible to get the balance right?
It's a really important question, and it's one we talk about in every jurisdiction in which we operate. It's not a matter of removing important regulations. Regulations are critical to ensuring that a jurisdiction is taken seriously. Mm-hmm. And of course, this is a highly credible, world-leading jurisdiction, and it needs rules that work. It's about right-sizing them and finding ways to not apply a one-size-fits-all model across a very large and diverse set of stakeholders, but rather removing the onerous components of a regulation that aren't really adding anything to the regulator, but do sometimes disincentivize market participants from being more active in a certain region. So we think that it doesn't create a risk to right-size regulations. Now there is, as you know, a robust conversation going on around the world that's more of the financial stability vein, and that's certainly true here as well. And we think those are really important conversations that we are very active in as well, but that is not something that we see as being somehow troubled by right-sizing regulations that exist today.
Okay, and thinking about the non-bank industry, the NBFI as it's fondly called, there's been so much work happening on that internationally, locally with the Bank of England doing its SWES exercise. Would you be able to reflect a little bit on kind of the outcomes of that and what you think it means for regulators going forward?
Sure. The SWES has been a really fascinating exercise, and I think it's noted that many other jurisdictions seem to be following the work of the bank and thinking to themselves, you know what, we might want to undertake something similar. I would say largely those who participated in the SWES felt like it was a very fair and well-run process. It was iterative and really allowed those participating the opportunity to both provide information as well as learn. And I think what we saw with the results is a lot of learnings that were provided to all market participants globally. They're really helpful, giving everyone things to think about that might not have been as obvious in terms of a market stress and the assumptions one might make about how other parts of the market behave, and is that necessarily true? So again, a really well-run and fascinating process. Now, importantly, that did not stress test a non-bank entity. That stress tested the wider system. And when looking at other jurisdictions who might want to replicate some sort of model like that, we think it's critically important that it be looked at holistically, as the bank did, and also that it not be overly duplicative, in which we have members who are largely globally active, and having to be involved in such an exercise in 20 different jurisdictions at once might not be all that helpful or constructive, but really taking learnings from key exercises like the SWES and applying them in other jurisdictions.
Okay, would you advocate perhaps regulators undertaking more exercises like this before they kind of finalize international policy or think about imposing tougher rules?
Great question. My personal bias is you might as well learn and understand what it is you seek to regulate before jumping in and rushing to conclusions. So certainly applaud the way they went about that. I think a lot that can be taken from it again. But these are onerous processes as well, and there could be examples of times where quicker action needs to be taken that don't afford the opportunity to conduct something like this. But when possible, when a policymaker can really look down the road and around the corner at things it wants to better understand longer term, we certainly applaud first learning about those issues rather than acting.
Okay, and I think one of the buzzwords, or rather a buzz phrase, if you will, that I hear quite a bit is kind of this idea of hidden leverage, and that's what the Bank of England says quite frequently, and they talk about perhaps putting in more regulation to kind of stem that, and they quote some of the events that we've seen of the past years, the dash for cash, LDI crisis. Is that something you sympathise with, or would you say that that's not an issue caused by kind of the hedge fund industry?
So first, as you know, the Financial Stability Board is undertaking a major review on leverage throughout the system. And I think to the point of hidden leverage in particular, what is important here is that we understand where leverage exists in what it is and even how we measure it. And we find ways to bring that into greater consistency, because it's really hard when one jurisdiction's talking about something and another talking about something very different, but calling it the same thing. And I think the topic of hidden leverage is one that is more about understanding what is happening in the system and who is involved, and in many cases, the critical, valuable role those market participants are providing to overall financial stability to be able to anticipate future events. LDI obviously seems to be something that drove a lot of the motivation and attention here. There will be other things in other core markets that bring leverage into attention. We, you won't be surprised to hear, believe leverage is critically important to the global economy. And when there are knee-jerk assumptions that leverage needs to be artificially limited or constrained or eliminated even, that's where we get very concerned, because there are real market impacts there, real negative investor impacts, if it isn't well understood. The conversation around imposing entity level caps, for example, we believe is terribly misguided. We think when we all digest the findings of the FSB's important work over the summer, we probably see a lot of different ideas that are presented rather than there being kind of only one way of approaching that important topic. And the conversation around clearing and how enhanced clearing around the world in core markets can help better understand and better control different parts of leverage in the system. Also, there is a very important discussion going on around counterparty credit risk management and the impact that can have on leverage. So I think a lot more to come in that space.
Okay, well, that's good to hear. Lots more for us to write about. Now, we mentioned AIFMD before. We are lucky to have two regulators join us on the panel after this. So curious what you would be hoping for to see in UK regulation in the kind of coming months and years. You know, what kind of questions should I be putting to the regulators in the panel?
All the tough ones.
Yeah.
You know, I think they are doing a really great job getting off on the right track. AIFMD, I mentioned it earlier, but I think it is worth repeating, is fundamentally important to the alternatives sector, and also just represents, again, when looking holistically at the different ways one can structure in the UK to ensure that it's really done in a way that provides investors the important protections they should have, but also distinguishes between different types of investors and different types of activities, while at the same time where there can be consistency, again, with, you know, whether it's AIFMD, UCITS, and MiFID, or other ways to find greater consistency, that'd be important to do.
Okay, great. There is the kind of long-awaited Mansion House speech from Rachel Reeves coming up in July. Is there anything you would very much hope to see in that we haven't mentioned already?
You know, first I would say it has been really wonderful to see the efforts that were already in motion carried forward in the new government. And we think that they've done a really great job continuing to move forward on consolidated tape, short sale regulation, other areas that are very important to the industry. Now, looking at the opportunity to really take the microphone and talk about the future, it's important not only to reaffirm that the measures that were underway will continue, but also to send a really powerful message. It's an opportunity to send a message around the world that they are fully and permanently committed to this competitiveness and growth mentality, and to set in place a long-term strategy that really articulates that. Now, when you get into kind of the nuts and bolts, what are those pieces? There are probably a lot of ideas on their minds already, and we hope that they will approach that with more of an open mind than a contracted one in terms of what can be done. But I think as important as anything, it's just that message that she will be able to send, that they really mean this is the place to do business as an asset manager.
Okay. We've only got about a minute left, and I wanted to pick up perhaps on the elephant in the room, which is that you have an American accent. You're from America. What is your perspective from, you know, working for the MFA from within the US at the moment? You travel a lot. Are there any kind of lessons you bring over here, or anything you would like to see there, anything you would like to see here?
Yeah, great question. A lot going on in the United States, as you all well know. You know, the US right now, it's a bit of a dichotomy in terms of where we are in this administration in a unified government, in that there is the opportunity, as I mentioned earlier in the context of the UK, to recalibrate rules that don't serve a purpose. And we're working hard with regulators and across government to find those opportunities, not to deregulate, but to right-size. And that will be beneficial to the US economy, both to public markets and private markets. Now, at the same time, there is uncertainty and volatility in this government. So we work to help our members navigate a world and a US that remains potentially volatile, but also full of great opportunity. And when I think of the relationship of the UK and the US and the opportunity the UK has to continue to really be that bridge between the US and Europe, or the EU, for example, it's a really important and exciting time.
Okay, well, that's a great note to end on. Thank you so much, Jillian. Thank you for your time and for answering all those questions. I think we are just going to have a little stage change while while some more chairs are put on for the next panel. But if you'll all join me in thanking Jillian. Sorry, I will grab that. Okay, that was a quick stage change. Thank you very much to my panelists for being here. I will introduce you all. So I will start from the very end. We've got Rachel Blake, who is an MP for Cities of London and Westminster and a member of the Treasury Select Committee. Next to her, another MP, David Pinto-Jasinski, who is also a member of the Work and Pensions Committee. Then we have Max Beerbaum, Head of Research at New Financial. Then we have David Bailey, Prudential Policy Executive Director at the Bank of England. And last but not least, Simon Walls, Interim Executive Director of Markets at the FCA. Thank you all so much for being here. I thought we could start kind of thinking about some of the messages from the last conversation I just had with Jillian and David Bailey. I will specify because we've got two Davids on the panel. I thought we could start with you. Jillian spoke about, it's not about deregulation, it's about right-sizing regulation. But, your governor, Andrew Bailey, has been quite vocal in saying there is no divide between good regulation and growth. So does that mean we don't need to make any changes to the current policy?
No, it doesn't. Well, first of all, Fiona, thank you for inviting us onto the panel. It's great to be here. It's a really important point to highlight, and we heard some of Jillian's remarks. We didn't quite hear all of them as we were coming around for the room, so I have to be a little bit careful in what I say. But in terms of that point about financial stability and growth, there's just a few quick points I'll make. So the first one is, we totally understand and support the government's focus on growth. Really important for the economy, really important for the country as a whole. But secondly, from a Bank of England perspective, the single biggest thing we can do to support growth is to prevent a future financial crisis. They're super expensive. The analysis shows, on average, 63% of GDP is the cost of a crisis, and they have long-term scarring impacts. So it's really important that we take steps that we've taken the steps we've done over the last decade or so to build resilience in the system, and we need to maintain that resilience. That's important. But my third point is that doesn't mean we can't make changes that make that regulation work more effectively. So there's two things I'll point out. Firstly, Jillian pointed out one of these things, which is making regulation more effective, making it proportionate. We've done that in a number of ways. We've removed the bonus cap. We've removed a whole load of reporting. A third of reporting that insurers used to have to do have been removed over the last year or so, and we're looking at something similar in banking, and those are a couple of examples. But we can also support innovation, enabling firms to provide new products, new services, do things in different ways. And there we're working on things like the industry use of AI or our own use of AI. We're finding new ways for insurers to invest rapidly in productive investments, and putting in place new regimes for smaller banks so that they can grow more quickly. So there are changes we can make, but in doing so, we need to be really mindful of that point about maintaining resilience to prevent the future financial crises.
Okay. Simon, as the other regulatory representative on the panel, I mean, do you agree with that, but looking at it from kind of a consumer harm perspective, do you think there is, I mean, the FCA has been very active recently with, changing a few rules here and there, bringing in new policies. I know that we've been incredibly busy covering what you've been up to. But is there scope to amend the rule book while keeping consumers safe?
Yeah, absolutely. So I do agree with David but I also agree there is plenty of opportunity for change and to step into the enhanced risk appetite. So there's more than a few rule changes. We set out 50 for this year in the PM letter that we sent in January, and we've put growth right at the heart of our strategy we published in March. I think David set out there were kind of no-brainers. The regulation needs to move with the times, and Jillian made some remarks around transaction reporting. If we can get the same information cheaper, we can get it commercially, or we can share it better between regulators. There were just some quick wins. That is our job, to make sure we're efficient always. And then there's stepping into an enhanced risk appetite. You invite me to talk about consumer protection. I think consumer protection is our objective. We'll always talk about consumer protection. It's much like financial stability. Has major cost if there are issues, major cost of consumer scandals and trust, of course that materially affects economic activity, and trust in finance is a big thing. But we're subtly changing the language. We're talking about supporting the consumers through their financial lives. I think on the investment risk, we're completely clear, and I think there's a consensus with lots of parties now that consumers in the UK need to be investing more if they have as long as they have a sufficient liquidity buffer to manage their needs. They need to be investing because we have pressing retirement later life issues. So I think there's a building consensus in the UK around that, and that's fantastic. And when it comes to products like insurance or banking, exposure to financial services is good for people. So generally there isn't a hard tension between growth and consumer protection. Of course, at the margins, there are. So with each of our consultations, we're raising the risks and saying, look, does this fit with societal risk appetite, which we don't own entirely on our own? So if we take an example, we're currently considering changing some of the rules around mortgages, trying to make it slightly easier for first-time buyers and others to borrow more. But of course, there is a downside to that. We have to all be comfortable with marginally more repossessions. And that's the steady, slow work of going through consultation by consultation and checking in, because we all own a risk appetite like that. The FCA can advance its views and sense where we are, but the reason we consult is to get the broader opinions, and we're doing that on each of those 50 things this year.
Great. So a lot of work for you, a lot of work for us probably as well, but that's only a good thing. Rachel, I wanted to come to you because the chair of your Treasury Committee, Meg Hillier, did put out an article not so long ago saying that actually she wanted to keep an eye on this rollback of regulation and that it could specifically hurt consumers. I wondered if that is a view that you agree with, and whether as MPs on the Treasury Committee you want to kind of probe this issue a bit more.
Yes, we certainly do. Thank you very much for the invite. This feels like a sort of glamorous version of the Treasury Select Committee with extra shining lights and extra dance music. So thanks very much for the chance to talk. So there's three things that I wanted to pick up on from the conversation so far. The first is looking at regulation for what. So we've heard a bit about prudential regulation and then consumer harm. And one of the things that we've talked about in the committee as well is that administrative part of the regulation and that need to identify where where the cost of transactions and the cost of that administration, where there is a risk that that is holding back growth and innovation. And I think that's the third big part of the jigsaw to understand that type of regulation and the impact. The second bit to talk about is the advice guidance boundary, which is an area that I'm disappointed I didn't hear from. I'm the first person to mention that. But I do think tracking that through our Treasury Select Committee is important in terms of encouraging some of that really informed savings behaviour from consumers, because it's that relationship between the confidence and trust that consumers have in financial services can encourage the growth that we want to see from some of the deregulation that has been proposed.
Okay. Great. David, you've caught my eye. Did you want to add something to that?
Well, no, I mean, it's really interesting. And for me, this is a quite timely conversation. So I was a special advisor to Alistair Darling during the global financial crisis. So a lot of my attitude to this is coloured by what I saw, sitting in the Chancellor's office, watching the Bloomberg terminal toll the bell of doom for banks, watching them implode is massively coloured my desire to ensure we have a safe system. And it's particularly resonant over the last few days because obviously we had the news just last week that NatWest, after 17 years, has finally returned to full private ownership. And so to David's point, the cost of financial crises can't be underestimated. And I'm also very conscious that we are living in a more uncertain world with more likelihood of shock, etc. So I think all of that suggests that we've got to be careful. That said, I do broadly agree, with what's been said beforehand. The Chancellor's absolutely right. I think the pendulum of regulation did swing probably too far in one direction, and it's right that it swings back. But I think, to pick up just a few points, firstly, I think, this is on, as we've heard, both the prudential and the conduct side, but we've already seen a lot of action on that, and, want to absolutely credit the FCA for their action on name and shame. There's further probably to go on certification, but there's important stuff there. Similarly, some of the work on the prudential side, and if you look at where we're getting to on Basel 3.1, obviously that's kind of, waiting and seeing, but you'll note the UK's outcomes were less restrictive and less onerous than Europe's. That said, I think there are, and I think that speaks to a truth, which is the system is much, much, much safer than it used to be. But I think there is, we are at the kind of tail end of a bell curve where we probably can move some elements without really compromising on either the consumer duty or on macroprudential stability. I think I'll just make three other points here. One is that the efficiency point's really important. So I also chair the APPG, All-Party Parliamentary Group for Financial Markets and Services. And so many of the things I hear from large institutions aren't just about the substance of regulation, but the way it's enforced and the way supervision happens. And I think there's a lot that can be done just through streamlining, through speeding up, to make that experience better and to lessen that burden as it's actually experienced, point one. Point two is we do, though, need, and so I think there's a lot that can be done, but we do need an explicit conversation about trade-offs. Because exactly what's being pointed towards is that we will move these things. I don't think there are great trade-offs for some of these things, but clearly there'll come a point where there are bigger ones, and I think we've got to go in with our eyes open. But two final points. The third point is, though, this isn't all about regulation. So much of this behavior is about risk culture in firms. Now, regulation is one of the roots of that and one of the drivers of it, but only one. And actually, we've often seen that firms will move in a more tentative manner than regulation allows for them, not least because of internal cultures and the way compliance works. And so I think it's also for firms and boards to kind of address that. And my final point's around what the next crisis could look like, because we're talking about how does this help growth, but I suppose there's also a question about what could the next crisis be and how does one best protect for that. And look, a couple of points. One, we don't know. There are things I'm nervous about. I'm conscious that, for instance, there's some talk in, say, the US Basel endgame about changing the way they risk weight for operational risk. I think that's interesting and may bring some challenges with it. But in a world where we don't know, so much of it's about having a flexible and adaptable regulatory response. And if you look at, for instance, the resolution bill that we're just passing through Parliament at the moment, it's absolutely intended to give it to us. So I think at the same time, this is back to the point, we can increase the kind of the frontier along which growth can happen while simultaneously actually continuing to make our system safer.
Great, thank you. Max, I wanted to come on to you because you put out a report, well, your firm put out a report in October, October last year, essentially arguing the balance between stability and risk in UK regulation has swung too far. Now, that is very much the message that is coming out of the government at the moment. Could you explain a bit more your findings on that? And do you advocate for kind of a full regulatory rollback to pre-2008, or is it little tweaks here and there?
Absolutely not. But yeah, the beauty of working in a think tank is that you can take a step back and try to look at the bigger picture. And that's what we tried to do with our research project last year, where we looked at what are actually the market outcomes that we are seeing in the first 10 years since the current regulatory framework has been set up. And we think it's not the ones that we would like to see. So activity has fallen, and we looked at 60 metrics across banking, finance, asset management, all the important metrics. Activity has fallen in over half of the metrics in real terms, in 2/3 of those metrics relative to GDP, and in 80% of these metrics, growth has been slower in the US. Now, we're not blaming the regulatory framework for this, but of course it plays an important part in this. And what we think is, and David has just mentioned this, that this balance between risk and regulation, between risk and protection, has maybe gone too far towards protection, too far towards regulation. That doesn't mean we need to roll back everything that we've implemented since 2008, because there are good reasons why these things have been implemented. But we need to ask ourselves, do we really want an environment where, for example, £400 billion are sitting in cash ISAs, where the allocation of household savings to investments has dropped by 1/3, where pension funds are not investing in growth assets anymore? I don't think we do want this, because that is actually creating risks elsewhere. If you look down the road, this growth that we're missing, that is creating risks in the future. And so we think we need to reset that balance. I think we are on a good track to do this. And yet it's much more about fine-tuning the system, finding where's the complexity, where's the overlap, instead of rolling everything back.
Okay. I'm very curious about kind of finding this right balance between, a little bit might need to be changed, but let's not go, full 2008, because then that really could risk another crisis. But David, I'm curious to hear from you, because, if I think about what some of the city firms have been asking for, recently there's been this call to roll back ring fencing, at least by certain firms, not all of them. Andrew Bailey said in a letter that was published to the Treasury Committee this week, let's not do that, but there is possibly a chance that little bits could be tweaked here and there. So I'm curious if you think that's the right approach. Is it just kind of, small but steady? And you mentioned at the beginning as well, kind of this possibility for innovation, and that could be a way to achieve growth as well. Is that how you're looking at it?
So look, I think there's a number of things that we can do as an organisation and as regulators alongside the FCA. But a couple of points I'll make at the beginning, which is first that it's not the case that we've operated a zero failure regime up until now. Firms, we're there to regulate firms, and if they make bad business choices, they will and they can fail. But the important thing is when they do fail, they don't impact the broader system in a really negative fashion. So we've over the first 10 years we were in operation, we authorised 40 new banks in the UK, 30 new insurers, and we've had a sizable number of exits as well. And so it's really important that we can allow firms to support them in starting up and competing, but also failing in a quiet way. And that's where our proposals around resolution, around solvent wind down are super important. But in terms of should we make big changes or lots of little small ones, I think it's a balance between the two. Some of the changes we've made are really quite radical. Look at our proposals around the regulatory regime for small banks. When we left the EU, we inherited a regime that applied the same rules to all banks. We've really significantly simplified pretty much all aspects of the prudential regime for smaller banks in our proposals, whether that's reporting, taking out all of the administrative costs that have been mentioned previously, whether that's liquidity requirements or all elements of the capital stack. So there's a lot we can do from that perspective, which is actually a really big change for those firms. We can also do lots of little changes, and there's other examples where we're doing that. And then innovation is really important. So enabling new products, new services. I gave a few examples earlier, but I think it's really important that we enable, for example, with artificial intelligence, we have a framework that enables firms to get the best out of that, and for ourselves to use AI in a way that makes us more effective, more efficient, can do some of our roles faster, at lower costs, more efficiently. But we've got to make sure that industry adopt that in a safe way that doesn't then have an impact on the broader system.
Simon, I wanted to ask, we've spoken about taking more risk, but also, things will go wrong. The Bank of England doesn't operate a zero failure regime. The FCA, I'm sure, as rules change, and even if they wouldn't, things will happen. There will be consumer harm. But there's obviously been a call from the FCA to put in place kind of metrics to say, essentially from the government, this is what our risk appetite is. And it's kind of an insurance policy, I guess. So if something goes wrong, it's not your fault. Is that the way you see it?
I wouldn't use that term insurance policy because that makes it sound very much about the FCA's reputation. I think regulators aren't going to be the ones driving growth. We don't have an R&D department, and we don't invent new products. So it's obviously companies, but companies are looking at the regulatory environment and the political environment and deciding where to site their business and deciding whether to innovate. And I think the environment will want to look at us and say, you're all speaking a good game, but how long is this going to, I'm making a 5-year investment or a 20-year investment. Are you committed to this? And I think that's where concepts of tolerable failure really help, because it's showing we're not just saying nice words around risk appetite. We've confronted the downside of the risk, and we've decided, yes, that it's worth confronting that. It's worth marginally more small banks failing, or it's worth marginally more. These discussions need to take case by case. Marginally more financial crime, those things need to be discussed. And when you discuss them, so it's great that we're all talking risk, and we're inviting an adult conversation. The next level is to go topic by topic in those kind of consultations I said, or theme by theme, and try and get a broader contract, because then that means it will stick. It means when the first thing risk crystallizes, which we expect, that we will hold the course. And I think firms, people, entrepreneurs, asset managers will be looking at us saying, are you committed to this? We heard good things. Both of the regulators have started. We're building a track record of reform, but we want to be doing this for years. And so I think that's where the tolerable failure comes in. But it also does come into our decision making. So we've talked about the no-brainers. So the FCA has to be as efficient as possible. So that's a no-brainer. There's no downside. But on the other things, we need to know where to calibrate. On the wholesale side, we've done some really bold reforms and have some really bold consultations out there. So the listing reforms were enormous and really shifted the balance of disclosures in the UK. What we've got coming down the track on capital raising, we're moving the current, we've consulted on moving the current threshold from 25% of new capital to 75%. And there's a big risk there. So if you're an existing shareholder, you might say, some people will say, well, I like the ability to intervene, to have a vote. Now I don't get that. So we need to discuss that, or the FCA, need to raise that downside, discuss it, and then when we agree it, it's final. And one would hope that we would all then be able to stand by the downsides as and when they emerge. And I think that's the key, getting to that next level of the discussion.
Okay. Rachel, will you be hauling Simon and David in front of the Treasury Committee if things go wrong?
I was just thinking about this tension and what the politics are of this, and it is uncomfortable talking about tolerable failure, because these are people's lives and mortgages, and that could be their savings, and the transaction costs for individual households is deeply worrying, and that's the responsibility of David and I as politicians, as representatives, to be making sure that what is considered a tolerable level of risk as opposed to harm. And so there's 3 things for me that jump out of it. The first is transparency and making sure that there's that governance in place, and that's politics. That's the Treasury Select Committee having those conversations and probing those issues, and civil society like this, and having these conversations out in the public public domain. But the second one, which I think is harder, is about knowledge asymmetries. Now, and what the actual impact, there was so much consumer impact of the 2008 crisis. We're arguably still living through that now. But the extent to which there was that public level of understanding about how much risk was being taken with individual householders' money, probably not that much. And I'm sure that was in David and Alistair's minds when you were watching those screens at the time. And I think that's probably where, for me, as a representative, there is the biggest tension, is around the knowledge asymmetry and the understanding there is that responsibility for both prudential and conduct regulators to make sure they have to be processing all of that different information that goes into the banking system because they have been given that trust and confidence by consumers because it is their money. And then the third thing that's at the front of my mind, linked to the knowledge asymmetry, is the distributional impact, because there are some people for whom a tolerable failure or tolerable harm would have a devastating impact actually on their household income and their household expenditure. And there are others, if they have slightly higher rates of savings or different housing situations, for whom those kind of risks are more tolerable. So I think addressing each of those, the transparency, the knowledge asymmetries, and the distributional distributional impact, is a way of managing some of that tension around what sort of harm and risk is bearable. And I would argue that we need to make sure that the risks are considered in that transparent way and that's accountable, so in the Treasury Select Committee and in settings like this, as a way of moving forward with the deregulation and growth debate.
Okay, did you want to come in on
I
that?
did, yeah, because whenever I look at Rachel, I think, oh my God, how did she mention AGBR before me? So let me come in quickly, because we as a country have shifted a lot of investment risk on to individuals with pension reforms and the changing culture from DB to DC. But our culture hasn't caught up in the way that the US has has investment at the forefront. And that does leave our consumers vulnerable in investment markets. It leaves them prey to scams and slightly uncertain. AGBR is one of the steps towards that. So at the moment, 9% of people in the UK...
Does everyone know what the
Well,
AGBR
I will
is?
explain it. At the moment, 9% of people in the UK get financial advice, and that is, sometimes people call it full-fat financial advice. It is tailored to you, but as a result, it's expensive. So we have the Advice Guidance Boundary Review going on, where we're looking to introduce new types, including targeted support. So much like you might have in your Amazon, people like you might buy this or might do this with your financial solution. We think that's a good idea, and at the moment it's getting good discussions and good press. But I need to be clear about the downsides, just so because that's how these things hold. Those people using targeted support won't get bespoke advice, by definition, and it might be free. We think it'll be an excellent service. But some of those people will have something peculiar in their circumstances which isn't flagged by that people like you wasn't quite good enough. And so we just collectively need to know. I think that will be much better, because 80% of people who currently don't get any advice will get some guidance, and that will be better. But we can't have finger pointing, or we can't move back from that idea when some people get something which isn't perfect for them. That must be right. I don't think that is too controversial, but we just need to keep talking about it so our eyes are open, so we're clear as we step towards it, and we can build the safeguards around it, so we can spot those people who are doing things which might be illogical in their circumstances.
Okay.
The tension and the concern is that where there's innovation in products, and there are a number of products out there that might find their way to the Treasury Select Committee at some point, and the fear is that politicians come along and they say to the FCA, why on earth wasn't that within your, why did you allow that to happen? But if we meet those transparency tests and talk about where there is that real imbalance of knowledge, then I think that we can navigate this. Dave?
So, and I look, and wanted to thank Rachel, agree with everything she said, and also extra prize for bringing up the Advice Guidance Boundary Review. That is fantastic. But look, to build on those points, firstly, this is about more than just politicians. One of the problems is that this discussion can't just happen in Parliament and in Whitehall, right? If we're going to deal with some of these issues, fewer UK citizens hold shares than they did in 1960. We've heard the 400 billion in cash holdings. These are some big systemic problems. There are trade-offs, And they need to be not just talked about in Parliament, but properly absorbed, to your asymmetry point, more broadly, because otherwise you will get a political dynamic that doesn't allow us to move forward with consensus. Point one. Point two is, I think Parliament does need to try to speak with a more consensual voice on this. I'm really struck by, the FCA, in almost the same week sent a remit letter, and then the Joint Committee on Regulation was tearing strips off you for doing, exactly what the remit letter would suggest that, government wanted you to do. So I think we need to be clearer as a legislature, as a government, as a society, what those kind of instructions are. I think, kind of beyond that, then it comes back also then to risk appetite within firms as well, because there's a kind of conversation about how we protect the public. There's also a conversation about how firms take risk, how they're layered off, how they take responsibility for it, and not just risk in the macroprudential sense, but in the kind of risk they run with their customers' money. And that's also a conversation that can't just be up to regulators and can't be up to the government. I mean, one of the things that is not a frustration, but a real observation is the number of times I have conversations with large institutions, the gist of which is, we would like to take more risk, but government needs to essentially indemnify us from the impact of that. And we're not prepared to change our culture otherwise. That can't be the answer. So regulators have a big part to play, government and the legislature have a part to play, but so do institutions and so does the wider public.
Yeah.
A very specific example of what I would like to see to come out of this debate is, whenever you buy or try to buy a share or do some form of investment, there are about 10 flashing risk warnings that I'm going to lose my money, that capital is at risk. I want to see those risk warnings when I put too much money in a cash savings account with too low interest rates, that over time, because of inflation, that money will erode in value. But I don't get this warning. I want to see a warning if I'm 25, I'm joining my first workplace pension, and my default fund is 40% fixed income. I don't need that when I'm 25, not as the default fund. I can choose my risk tolerance, that is fine. But I want to have those warning signs that also tell me if I'm making maybe not the most sensible long-term decisions. But at the moment, that isn't happening.
So, what's stopping? I'm interested. Is there anything preventing that right now?
I think some firms might be nervous about giving financial advice at the moment.
You think it would be the advice guidance boundary?
Yeah.
Okay.
But I think that is one of the restrictions. It is partly risk appetite, but it is also, would that constitute advice? Because they would see your details and they might feel they would be liable if they got it wrong. But that is what we're trying to address. It's in the subject of nudges. You would want hey, we've noticed this, do you want to think about?
So, but there is something else here as well, and that's absolutely right. But we also know, so recent research has been done looking at how particularly consumers who haven't got large investments, how they think about risk, how they think about those investments. It's really interesting. The impact of some of these warnings is itself asymmetric. So if you I think it's Lloyds Bank did a very big study looking at this, which published just very recently, or I think is due to come out shortly. And what it basically found was that, having read these warnings, the majority of consumers thought, so the warning rightly says your capital is at risk, but that was interpreted as if the stock market goes down, I will lose all of my money. Yeah. And so it comes back slightly to this education point and this sense of trying to quantify without violating the boundary, quantify and contextualize the kind of risk people are taking, because without that, one of the things I'm struck by is people talk about, for instance, ISA reform, but what we also know is most people in Britain who use their cash ISAs, they use them almost as a kind of tax-free savings account with drawing down as well as building up. So it's not even clear if you change the tax treatment that you change that behavior. You've got to address some of the deeper risk behavior.
This has been fascinating. I'm going to turn the conversation ever so slightly because I did want to get into the topic of, London as an international financial centre, and there's a question on Slido which I'd like to ask. I think first to you, Max, and then to David, but what are the opportunities in financial regulation in the UK arising from our possibly closer relationship with the EU?
Mm-hmm. Interesting. I think what we are seeing right now, what is really interesting is that even though Brexit happened, even though it's two economies now, many of the questions that the two economies are asking themselves, many of the challenges that they are facing in terms of economic growth, in terms of investment, they are largely the same. And so both markets are largely looking at the same questions, probably will end up in sort of the same area, maybe on different timelines, maybe with slightly different interpretations of the rules, but I think overall we are moving in the same direction. Now, at the same time, when the EU is sort of slightly tweaking its rules and the UK is slightly tweaking its rules in a slightly different way, we're still diverging. Maybe accidentally, not on purpose, not because, you know, the UK wants to become so much more competitive than the EU. I think that's a debate that we had 5 years ago. But it does make sort of the closer collaboration a bit more tricky. But what I think it does help with is learning from each other. So looking at, you know, what has the EU done with their green taxonomy? What can we learn from that to maybe improve on that? And the EU is looking at the UK in the same way.
David, I'm curious to get your take.
So it's a really good question, and obviously Europe is a really important trading partner for us, and we have a large, vibrant financial centre within the UK. We know that our regulation can impact on the financial sector, on growth in a number of ways, in terms of how capital is allocated, the competitiveness of our firms abroad, and how attractive the UK is as a place to do business for foreign firms. And so it's really important we think thoughtfully about how we position our regulation alongside other jurisdictions like the EU. And that's where international standards have a really important part to play, certainly in prudential regulation. Our secondary objective actually around competitiveness and growth is grounded with a rider which is subject to alignment with international standards. That's really important. And so from a prudential perspective, whilst it's very important that we think about UK-specific needs and we tailor our regulation, as I've explained we've been doing since we left the EU, to UK-specific needs, that there's an underlying sort of basis of alignment with international standards, so that firms from abroad can come and do business with confidence in the UK, and regulators abroad have confidence that when a UK firm seeks to do business in their jurisdiction, they know that they're being regulated at home to a high standard. And I think you see, as Max has said, a lot of alignment between what we do and the EU does. If you look at, for example, the Basel proposals that we published last year, in the vast majority of cases, we in the EU are all based off those international standards defined in Basel. So it's a really important question. I think in many cases we've got similar but not quite the same, and that's good enough for firms to operate with confidence on a cross-border basis.
I do have to ask you about Basel, because there's been so much going on in the last couple of weeks. You know, even recently there's news out the US saying that, you know, as we know, the rules will likely survive, but in quite a watered-down way. Is that something you're keeping an eye on closely?
Of course. And we delayed our. We announced at the beginning of the year that we were delaying our implementation of the Basel package in the UK until early 2027, in part because there was a lot of uncertainty around the direction of travel in the US, and it's important that we have a sort of coherent cross-border picture. And now we're starting to see more clarity emerge from the US, appointments to the key regulatory agencies, or at least nominations. In fact, I believe that the Vice Chair of Supervision appointment is going to the Senate for vote this evening. So we may, in fact, have more clarity tomorrow on the direction of travel in the US. So we're watching that very closely. We're watching and in close dialogue with the EU as well, and we'll sort of set out in due course where we're going.
Okay, and Simon, what does it mean to be kind of the city and the markets regulator at a time like this, when, you know, London is very much looking to what's happening in the US and the EU, but very much is a destination in its own right?
Yeah, and actually a lot of our reforms, a lot of growth is going to come from the wholesale side, and we've been talking about the interaction between the wholesale side and the retail side, the demand side, but we're absolutely proud host of international markets in the UK and have been for centuries. And of course, lots of the focus is on equity markets, and Max does a lot of work in his team, but also on other markets. We're world leading in many of those, in commodities and in fixed income. So we have a responsibility to get the rules there right. And without going through a long list of them, you will see reforms that we've done so far and coming down the track are generally getting out the way as the regulator for approvals and pushing more transparency. And we've been doing that on the equity side, we're doing it on fixed income, we're doing it in commodities, giving more power to the venues. So there are lots of tweaks there. There are changes that we think are right. I think that there is a competitive dynamic, but when the regulators talk, we're often trying to solve common problems. Like it won't be regulatory relationships that get in the way as and when there are other conversations. Just won't happen. There's currently a big international meeting around what we do about finfluers, for example, on the consumer side. We're just always trying to solve. So there's good relationships there. We're looking to make life as reasonable as possible for international firms that work here. So we don't want divergence for divergence sake, as David was getting towards. Quite often, we're removing things entirely. So we're currently considering the cost of having different rules or reporting from the EU might be quite high. If we just remove ours, then there's optionality for firms, and there's like little cost from removing something. We've removed regulatory returns for, I think, 35,000 firms already. So we're going through that steady work.
Okay. And Max, I just wanted to ask very quickly, you know, the UK has been given the one equivalence decision survives after we left the EU. Do you see any scope for that changing?
I don't. But what I found interesting was that one equivalence decision, when it was extended this year, there was absolutely no debate about it whatsoever in the EU. The last time it was debated, you know, France freaked out, Germany didn't like it. But now I think, especially the EU, but I think both markets realized actually, you know, we are still one continent, and maybe it's not so sensible to try to compete with each other, but look at where is Europe on the world map, what are the common challenges, and, you know, can we look beyond that political drama that we had the last 5 or 10 years and find these areas where we can work closer together. Another good example is the move to T+1, where the UK and the EU will move together, which makes absolute sense. But maybe 5 years ago, this would not have happened.
Okay, we've got about a minute left, so I just want to come to each of the panelists and just ask you, you know, the changes that we've seen over the last 10 months or so, you know, we're definitely heading in a new direction for financial regulation. Do you feel, in about 20 seconds or less, that we are now getting the balance right? And if not, what needs to change? Rachel, do you want to start?
Yes, I think we're getting the balance right. I do think that we need to look at that advice guidance boundary through the lens of the distributional impact of the benefits of growth.
Perfectly short answer. Well done, David.
I completely agree with Rachel. I think we're getting the balance right. And my challenge is, as we get that regulation right, it's now for firms to adapt their risk appetite to kind of move with that.
Max?
I agree with that. I think we are getting the balance right. But what I would like to see is the industry giving the regulators also permission to take a risk and sometimes fail. You know, you could argue that naming and shaming was the regulator taking risk and it didn't succeed. But, you know, was it the end of the world? I don't think so.
David?
I think, I think we're making positive progress. I think we need to keep going with making regulation work more efficiently, more proportionately, supporting innovation, but always remembering that financial stability and growth go hand in hand.
Okay. And last but not least, Simon?
Right track, big strides, but we really need to keep this conversation going on risk so we can stick to it for the long term.
Okay. All right, perfect. That just leads me to thank the panelists. This has honestly been such a fascinating conversation. I really think it is the most important topic. At the moment, I'm highly biased, but it's been great to have you all here. So please join me in thanking the panelists. I mean, that's it from us. Thank you, everyone, for coming here and online. Thank you again to our partners, MFA, for hosting this event. And you'll all be pleased to hear there are drinks happening next door. So without further ado, please go enjoy a drink. Thank you.